very good afternoon to you. I am Professor Anuradha Jain, Professor of Economics and Principal at Vivekananda Institute of Professional Studies. So in this lecture, we are going to discuss about Indian money market. The money market is a market for lending and borrowing of short-term funds. It deals in funds and financial instruments having a maturity period of 1 day or 1 year. It covers money and financial assets that are close substitute for money. The instruments in the money market are of short term in nature and very highly liquid assets. If we talk about the structure of Indian money market, then Indian money market consists of two segments, namely organized sector and unorganized sector. The RBI is the most important constituents of Indian money market. The organized sector is within the direct control of Reserve Bank of India regulations. But on the other hand, the unorganized sector comprises of indigenous bankers, money lenders, and unregulated non-banking financial institutions. Now, let us discuss about the structure of the money market in the organized sector. In the organized sector, the main instruments of money market are call and notice money, treasury bill market, commercial bills market, market for certificates of deposits, that is CDs, market for commercial papers, CPs, repo market, money market mutual funds, discount and finance house of India. In unorganized sector, mainly it consists of indigenous bankers, money lenders, unregulated non-bank financial intermediaries like chit funds, nidhis and loan companies, and finance brokers. Now, let us discuss the first instrument of organized money market, that is call and notice money market. Now, under call money market, funds are transacted on overnight basis. As far as notice money is concerned, then funds are transacted for the period between 2 days and 14 days. The funds lent in the notice money market do not have a specified repayment date when the deal is made. The lender issues a notice to the borrowers 2-3 days before the funds are to be paid, and on receipt of this notice, the borrower will have to repay the funds within the given time. Generally, banks rely on call money market where they raise funds for a single day. The main participants in the call money market are like commercial banks and excluding the regional rural banks, cooperative banks and primary dealers. Discount and Finance House of India, that is DFHI, non-banking financial institutions such as LIC, GIC, UTI, NABARD, etc. are allowed to participate in the call money market as a lender. Second instrument is treasury bills, which is in short we can call it as T-bills. Treasury bills are short-term securities issued by Reserve Bank of India on behalf of the Government of India. They are the main instruments of short-term borrowing by the government. They are useful in managing short-term liquidity. Now, at present, the Government of India issues 3 types of treasury bills through auctions, namely 91 days treasury bills, 182 days treasury bills and 364 days treasury bills. There are no treasury bills issued by state government. Now, with the introduction of the auction system, interest rates on all types of treasury bills are being determined by the market forces. The treasury bill issues now consist of weekly 14-day and 1-day bill auctions and 364 days bill auctions on a fortnightly basis, combined with 14 days intermediate bills available for state government and foreign central banks. Now, I would submit here that there have been recently very significant initiatives by RBI in this area. The auction procedures were streamlined, to have notified amounts for all auctions and to accept non-competitive bids outside the notified amount. The uniform price auction for 91-day bills has also been introduced as an experimental measures, and the Reserve Bank's purchases and holding of treasury bills have become totally voluntary with the discontinuation of ad hoc tap 91-day treasury bills and extinguishment of 14-day intermediate bills on rediscounting. Now, another significant recent development has been the addition of treasury bills in the open market sale window of the bank. Now, in brief, the development of treasury bill market is at the heart of money market development, and hence the Reserve Bank has been paying special attention and continuously reviewing the development of treasury bill market. Now, as in the case of other instruments, the demand for treasury bill is also inversely related to call money market rates. The supply is adjusted taking into account the demand conditions as also the short term needs of the central bank. In 1998-99, the availability of fixed rate repos at 8% since 1998 caused some disinterest in treasury bills. With the auction rates more aligned with the market recently, the interest in the treasury bills has significantly revived nowadays. Another instrument is commercial bills, and commercial bill is a short term negotiable and self liquidating instrument with low risk. They are negotiable instruments drawn by a seller on the buyer for the value of goods delivered by him, and such bills are called also trade bills. Now, when trade bills are accepted by commercial banks, they are called commercial papers. If the seller gives some time for payment, the bill is payable at future date, and generally the maturity period is up to 90 days. During the usance period, if the seller is in need of funds, he may approach his bank for discounting these bills. Commercial banks can provide credit to customers by discounting commercial bills, and the bank can rediscount the commercial bank bills any number of times during the usage period of bill and get money. Certificates of deposits, another instrument, are unsecured, negotiable promissory notes issued at a discount to the face value. They are issued by commercial banks and development financial institutions. Commercial deposits are marketable receipts of funds deposited in the bank or a fixed period for a specified rate of interest. CDs are introduced in India in June 1989, and the main purpose of the scheme was to enable commercial banks to raise funds from the market through these commercial deposits. Now, according to the original schemes, CDs were issued in multiples of rupees 25 lakhs, subject to the minimum size of issuing being of rupees 1 crore. They had the maturity period of 3 months to 1 year, and they are freely transferable, but only after the lock-in period of 45 days after the date of issuing the CDs. Another is commercial papers, and it is also very, very important instruments in the hands of the money market, and CPs were introduced in India in January 1990, and commercial papers were launched in India with a view to enable highly rated corporate borrowers to diversify their sources of short term borrowings and also to provide an additional instrument to investors. RBI has modified its original scheme in order to widen the market for commercial papers, and corporates and primary dealers and all the Indian financial institutions can issue commercial paper. Now a corporate can issue CPs provided they fulfill the following conditions. And what are those conditions? These conditions are like the tangible net worth of the company is not less than rupees 4 crore. Secondly, the company has been sanctioned working capital limit by banks or all financial institutions. Another one is the borrowed account of the company is classified as a standard asset by financing institutions or bank. Now, if we come to the next, instrument of money market, then it is very important and which is known as repos. Okay, repos. And repos typically it signifies, lending on a collateralized basis, and the term of contract in terms of a repo rate representing the money market borrowing lending rate. Now, as in the case of other instruments, repos also help equilibrating between demand and supply of short-term funds. Internationally, repurchase agreement, that is repo, is a versatile and perhaps the most popular money market instrument. Now, a repo or reverse repo is a transaction in which two parties agree to sell and repurchase the same security. Now, under repo, the seller gets immediate funds by selling specified securities with an agreement to repurchase the same at a mutually decided future date and price. Now, similarly, the buyer purchases the securities with an agreement to resell the same to the seller at an agreed date and price. The repos in government securities were first introduced in India since December 1992, and since November 1996, RBI has introduced the term reverse repos, that is to sell government securities through auctions. Another instrument is Discount and Finance House of India, that is DFHI. It was set up by RBI in April 1988 with the objective of depending and activating money market. Now, it is jointly owned by the Reserve Bank of India, public sector bank and all India financial institutions which have contributed to its paid up capital. The DFHI deals in treasury bills, commercial bills, CDs, CPs, short-term deposits called money market and government securities. The presence of DFHI as an intermediary in the money market has helped the corporate entities, banks and financial institutions to invest their short-term surpluses in money market instruments. Another is like money market mutual fund, MMMF. RBI introduced money market mutual fund in April 1992 to enable small investors to participate in the money market. Now, money market mutual fund mobilizes savings from small investors and invests them in short-term debt instruments or money market instruments such as call money, repos, treasury bills, CDs, CPs, etc. Now, these instruments are form of debt that mature in less than a year. Now, as far as the unorganized sector is concerned, then unorganized Indian money market is largely made up of indigenous bankers, money lenders and unregulated non-bank financial intermediaries. They do operate in urban centers, but their activities are largely confined to the rural sectors. This market is unorganized because its activities are not systematically coordinated by the RBI. Now, indigenous bankers are financial intermediaries which operates as bank, receive deposits and give loans and deals in the hundis. The hundi is a short-term credit instrument and it is indigenous bill of exchange, you can say. The rate of interest differ from one market to other market and from one money lender to the other, and they do not even depend on deposits entirely. They may use their own funds for lending money. Now, money lenders are those whose primary business is lending money, and money lender predominate in villages. However, they are also found in urban areas. Interest rates are very high generally, which are charged by the money lenders, and large amount of loans are given for unproductive purposes. The borrowers are generally agricultural labor, marginal and small farmers, artisans, factory workers, small traders, etc. Unregulated non-bank financial intermediaries, these consist of like chit funds, nidhis, loan companies and others. Chit fund, how we define chit fund? They are saving instruments and the members make regular contribution to the fund. The collected fund is given to some member based on previously agreed criteria by bids or by draws. Chit fund is more famous in Kerala and Tamil Nadu. Now, as far as nidhis are concerned, they deal with members and act as mutual benefit funds. The deposits from the members are the major source of the funds, and they make loans to members at a reasonable rate of interest for the purpose like house constructions or repairs or for any personal use. They are highly localized and peculiar to South Indian markets. Now, finance brokers are also the part of unorganized money market sector. They are found in all major urban markets, specifically in cloth markets, grain markets and commodity markets. They are middlemen between lenders and borrowers. Now, if we talk about like features of Indian money market, overall general features, then several steps were taken in 1980s and 1990s to reform and develop the Indian money market. Now, despite these efforts, Indian money market continues to remain lopsided, thin and extremely volatile. Indian money market is relatively underdeveloped when compared to advanced markets like London and New York money markets. And the main defects of the Indian money market are existence of unorganized money market still after so many years, lack of integration, multiplicity in the interest rates, inadequate funds, seasonal stringency of money, absence of bill market, inadequate credit instruments. Now, existence of unorganized money market, this is one of the major defect of the Indian money market. It does not distinguish between short term and long term finance, and also between the purpose for which the finance has been created or taken. Now, since it is outside the control and supervision of Reserve Bank of India, it limits the RBI's control of over money market. There is lack of integration, and the Indian money market is broadly divided into two sectors like the organized money market, unorganized money market. The organized money market constitutes like several institutions like RBI, State Bank of India, Commercial Bank, cooperative banks, financial institution, and RBI as an apex body regulates their working. But the unorganized sector is not homogeneous in itself. It constitutes indigenous bankers, loan companies, money lenders, etc. And there is no uniformity in their practices, and there is multiplicity of functionaries. Then another feature or defects of Indian money market is multiplicity in the interest rates. There exist too many rates of interest in the Indian money market, such as the borrowing rate of government deposits and lending rates of cooperative and commercial banks, lending rates of financial institutions, etc. Now, this is due to lack of mobility of funds from one section to the money market to another, and the rate differs for funds of same duration lent by different institutions. Then another defect is inadequate funds available in the money market. Now generally there is a shortage of funds in Indian money market on account of various factors like inadequate banking facilities, low saving, lack of banking habits, existence of parallel economy, etc. However, the banking development, particularly branch expansion, has improved the mobilization of funds to some extent in the recent years. Then seasonal stringency is of money and high rate of interest during the busy season is striking feature of Indian money market. There are wide fluctuation in the interest rate from one season to another. RBI has been taking various measures to avoid such fluctuations in the money market by adding money into the money market during the busy season and withdrawing the funds during the slack season. Then well organized bill market is necessary for linking up various credit agencies effectively to RBI. So the bill market is not yet developed on account of many factors such as practice of banks keeping a large amount of cash for liquidity purpose or preference for borrowing rather than discounting bills, dependence of indigenous bankers on one another, widespread practice of using cash credit, high stamp duty on usance bills, etc. Then inadequate credit instruments available in the money market is another defect. Then if we talk about reforms in the Indian money market, then RBI is the most important constituents in the money market, and by virtue of the implication for the conduct of monetary policy, money market comes within the direct purview of RBI, and various reforms has been taken, steps has been taken by RBI to bring reforms in the Indian money market. The committee has been set up and various steps were taken. RBI set up a working group on money market under the chairmanship of N. Vagul in 1987. Now, based on the recommendation of the Vagul committee, RBI initiated a number of measures to widen and deepen the money market, like deregulation of interest rate, introduction of the new money market instruments, and through these instruments the government, commercial banks, financial institutions, corporate can raise funds through the money market. They also provide investors additional instruments for investment. Then repurchase agreement, repos also system was changed. Many reforms were taken place in this area also. Then in terms of like RBI also introduced money market mutual funds in 1992 to enable the individual investor to participate in the money market. So in this way there were many reforms that has been introduced in the money market, and even though like there are many defects in the Indian money market system, but still we can say that it is very, very important market for raising the short term loans, and it helps in mobilization of the funds, and it also helps in arranging funds for the short term period, and directly or indirectly helps in the economic development of the country. But still there are various areas where more reforms are required. So thank you so much, and this was, I think, has cleared the main idea about what Indian money market is all about. Thank you.